All right, I think we are going to get started. Good afternoon, everyone, and welcome to today's complimentary webinar, The Longest Expansion on Record, which will be presented by Dr. Lev Borodovsky, Chief Risk Officer here at Star Mountain Capital, and also the editor of the Wall Street Journal's The Daily Shot. My name is John Polis, and I am the Chief Operating and Technology Officer for your webinar host, Star Mountain Capital, and I will be your moderator today. For those of you who are not aware of us, Star Mountain is a specialized asset management firm focused on investing in the large and underserved U.S. lower middle market of companies with typically under $15 million of EBITDA. Star Mountain's differentiated business model includes a custom-built media and technology platform bringing proven large market resources to smaller businesses as a value-added lender and investment partner. Before I hand over the reins to Lev, I did want to let you know that your audio is muted and will be for the entirety of the presentation. Also, as a disclaimer, I wanted to note that nothing presented in this webinar or webinar materials that you're going to receive constitutes an offer to sell or a solicitation of an offer to purchase by Star Mountain interests in any investment product. We have allocated time at the end of the presentation for Q&A. If you do have a question, you can type it into the Q&A chat box of your WebEx client. We will try to get to as many questions as possible before our time is up. Now, about our presenter. Dr. Lev Borodovsky has over 20 years of experience covering private equity, risk management, and operations. He was a founding team member and Chief Risk Officer and Managing Director for the GSO Blackstone platform, which was one of the most successful global credit and loan investing platforms ever. Currently, Lev is the Chief Risk Officer here at Star Mountain Capital, and he's also the editor of the Wall Street Journal's The Daily Shot, which is a chart-based newsletter covering select global economic and market trends that is now part of the Wall Street Journal. Lev, this is I think it's our fourth webinar together, and we're excited to get back together for this quarterly check-in.
Sounds great. Thanks, John. Really appreciate it. Good afternoon, everybody. Please excuse me, I got a bit of a cough, but I think we'll get through this okay. So this is, I write the Daily Shot, and the Daily Shot is about charts. And so we're going to take a look at a few topics in a chart-based format, visual-based format. It's a quick way to absorb a lot of information for me, at least. So we're going to talk a little bit about the U.S. economy. Here are some things we're gonna cover. First of all, how long is the U.S. How well is the U.S. economy doing now? We hear all sorts of news reports and so on. We're gonna look at some data. How long will this current economic expansion last? And then, how will the cycle end? What will be the catalyst for this expansion to finally come to a close? And we're going to look at three key risks that could trigger this the end of the economic cycle. One is trade policy, which is on the top of everybody's minds these days. Monetary policy, and the strength of the dollar. Which a lot of times people underestimate as a potential risk. So let's get started. So how is the U.S. economy doing now? If you look at the current quarter, I think we haven't seen this good of a situation in years. If you look at the median forecast of economists, they're basically saying that the current quarter GDP growth is on track to be at 3.4%, well above sort of averages that we've been running. And they've been, as the first chart on the left shows, they've been upgrading their forecast for this quarter for quite some time, and they continue to do so. On the right is a chart from the Atlanta Fed, which has a model that does what's called nowcasting, which is an estimate of economic growth based on all the parameters and data that's coming in real time. And they're looking at growth of above 4.5%, which is extraordinary for the United States. The economy is booming, and every indicator, major indicator you look at, shows tremendous growth, from manufacturing to labor markets. The economy is in great shape. And if you look at just an example, I mean, and there's dozens and dozens of these examples. On the left side on this chart, we show the freight index, both shipments and expenditures relative to previous years. And that's a good sort of real-time indicator of the economy. Shipping activity is obviously a measure of how the economy is doing. And we're well above the previous years and continue to trend higher. And on the right, again, we see a couple of forecasts, one from Oxford Economics showing, projecting this quarter to hit 4.5%, and on the bottom right is Goldman's forecast, which is close to 4% GDP growth this quarter, which is really impressive. One thing that's striking also is if you compare the U.S. to other large advanced economies, the U.S. is the only one that's been surprising to the upside, where economic expectations around the world have been a little bit disappointing. In the U.S., it's really surprising, how strong the growth is, and part of the reason is the great, what I call fiscal stimulus, or sugar high, as some people call it, where a massive tax cut, both in the corporate sector and in the households, as well as increased government spending, which is a fairly dramatic increase in government spending, which is surprising given that it's a Republican-run government. Spending is jumped significantly, and it's spending across the board from the Pentagon to other types of government spending, and those two things alone can explain some of this upside surprise. The sugar high. The question is, how long will this last? So this is an interesting chart. This firm called Bianco Research did they track things like news items, and they looked at news flow for items such as expressions as good as it gets and growth. And we see a spike recently in this sort of indicator, where basically news is saying, we're at levels that could be as good as it gets. And the question is, are we heading down from here? So how long will the current expansion last? So if you look at, here's one survey, and there are other surveys done like this. Basically, experts, economists are all saying that around the year 2020, so in 2 years, the economy, this economic growth will end. So the cycle this expansion cycle will come to an end. And some are saying maybe you'll give it another year, like go out to 2021. But it's not that far. So basically, let's say 2 to 3 years is kind of the range. Some are saying could be even shorter, like a year and a half. potentially. By the time this expansion ends, you will be the longest on record, and thus the title of this presentation. So if you look at the chart on the right, you can see in green the basically this is the latest expansion, and if it ends in say 2020, we're talking about 11.5 years, which will make it the longest recovery or expansion on record. I guess the next longest was in 1991. That was a part of the technology boom that took place in the 90s. But of course, this expansion is nowhere near as robust as the previous ones, and that's why it doesn't feel like, and talk to people and say, what are you talking about, the longest expansion? Well, it doesn't feel like the longest expansion because it's been so shallow, right? If you look at the rate at which the economy expanded this time around, it's been much slower than in the recent previous recoveries since the I guess the late 50s or early 50s, and that is potentially one of the reasons it continues to expand for this long amount of time. If you think about it, if the economy grew quicker, we would have had higher inflation and potentially more aggressive Federal Reserve, which would end the expansion faster. But given the slow nature of this expansion, the interest rates remained low for quite a long time and allowed this growth to continue. But as all good things must come to an end, and if you look at forecasts, they're all saying that this exceptional second quarter growth is it's an exception, right? It is not going to be repeatable. So on the left side, you have a chart from Capital Economics, shows the second quarter forecast of around 4%, and then dropping down for the third quarter and continue to decline as far as growth through the end of the year and early next year. On the right is a forecast for employment growth in the United States, which is sort of a good metric to measure economic expansions. And you see that this forecast says that in 2020 we'll have a much slower growth in employment. And part of the reason, by the way, for slower growth in employment is just there's the labor pool is pretty tapped. There's not a lot of basically slack labor out there. So that's one of the reasons employment growth will slow. But this particular forecast says that 2021 is when we'll see a decline, where you'll see some layoffs, and that's the next recession. So if you survey economic forecasters from all different walks of life, they will all have a pretty similar forecast projection for the economic growth in the next few years. One exception, of course, is the White House, that sees this growing at 3% per year indefinitely. Again, that's what it is. It's an exception. But if you look at the Fed, the CBO, the IMF, and all the sort of economic forecasts from private economists, all sort of are pretty similar, and they're basically saying that growth will decelerate pretty rapidly from here on. In fact, the Federal Reserve sees long-term, what they call long-run growth in the United States as below 2%. They don't see that, despite the recent improvements in the economy and great labor markets and so on, they don't see longer-term growth as being better than that. And there are really two reasons for that. Beyond sort of the cyclical factors, there's a structural issue with the United States economy, and that is population growth is basically slowed to a trickle. Labor force is not really growing, and to grow the economy, you can do two ways. You can either increase the labor force, or you can increase productivity. There's no other way. It's mathematically impossible to do it any other way, right? Labor force isn't growing, or barely growing, and especially as we get into more restrictive immigration policies, it becomes even harder to grow the labor force. And as far as the productivity, we haven't seen improvements. The productivity growth has slowed, and there's a little bit of a improvement lately because investment has gotten better, but people don't think it's going to be dramatic going forward. So that's kind of those are the reasons why all the economies are going to converge in the same figures. So let's take a look at how will the cycle end. What are the events, triggers that could bring an end to this extension? And the first one that's on top of everybody's mind these days is trade policy risks. So for those who joined us in our February presentation, you may remember we discussed that as one of the key risks to both the markets and the economy. And here's a slide from the February presentation. So this should not be a surprise for those who look at our presentations. Trade tensions will pose substantial risks to growth. We know that, and the market is sort of reflecting that. The biggest component of that risk, obviously, is China, where it's a massive trade activity with that country in place, and hurting that will have all sorts of adverse effects, especially if China retaliates, which will hurt quite a bit of production and employment in the United States. Certainly investment, and I'm hearing that the White House may pull back on their threats to limit tech investment in the U.S., but those things will definitely have an impact on growth. But that's not the only; those are not the only risks. NAFTA, for example, could have an even bigger effect. If you just pull out of NAFTA right now, it would be devastating for the U.S. economy. It would completely screw up the supply chains, where auto manufacturing could come to a halt, because if you think about a typical car, American manufactured car, it has so many parts from our NAFTA partners, and production goes back and forth. There are pieces being produced all over the place. And there are a lot of parts where a certain portion of it is made in the U.S., then another portion of it is made in Mexico, and then Canada puts finishing touches on it or something like that. There's plenty of those kinds of examples, and if you pull the plug on that, it could get pretty ugly. So that's a real problem, and certainly it will really hurt the farming community, which is already stressed. If you think about our rural communities, and you've seen recently prices of all commodities that are exported, such as soybeans, taking a serious hit recently, and that's going to impact some of the rural communities in the U.S. The other one that could potentially be also devastating is the threat of auto tariffs, which we'll talk about shortly. So the chart on the left shows what happens if the U.S. imposes automotive tariffs on basically all our trading partners. You're going to see significant job losses and a slowdown in activity. So this estimate says that the U.S. could lose 400,000 automotive jobs. That's in addition to about 70,000 lost due to the steel and aluminum tariffs, which are already in place. And the idea there is, our government decides to support the steel industry in the United States, which is basically a dead industry. It peaked back in the 50s or whatever. But we decide to support it, and what happens is you get manufacturers who say, wait a minute, I could buy expensive steel in the U.S. and try to manufacture stuff here, or I could already buy the manufactured product from abroad because it's cheaper, right? It's cheaper to bring it from abroad than produce in the United States because of high steel prices, right? So that's a real risk. And then if you look at the China situation, the chart on the right kind of shows the impact on both China and the U.S. as far as the economic hit. People say, oh yeah, we'll win the trade war. Of course the U.S. will win, quote unquote, the trade war. China will get hurt more than the U.S. In the trade war, but who has the staying power? Who has elections? I mean, you don't worry about Xi Jinping or anybody, Chinese leaders losing elections. That's never been an issue. In the U.S., we don't have the staying power because we have elections every 2 years, and that things could change very rapidly, and that's what China is counting on. So that's kind of one of the issues. All right. So look, continue with the trade situation. Tariffs are already starting to have an impact on, tariff threats are already starting to have an impact on the economy. The EU retaliation against U.S. products is forcing Harley-Davidson to potentially shift production to abroad, and that's just an example of what will happen if tariffs go into effect broadly. And then, on the right, there's a chart that shows what happened when the U.S. imposed tariffs on, washers and dryers, right, washing machines, and that basically prices have gone up dramatically, and including domestic producers raise prices, and that hits the consumer directly, and that's not insignificant. If that becomes widespread, you'll see the bigger impact. So factory activity has been in the U.S. has been pretty robust, pretty strong. But as aluminum and steel prices climb, some manufacturers are starting to worry, and some of them are concerned about making investments, building new factories. The uncertainty is a major factor in economic growth, and it could spread. So the June manufacturing index from IHS Markit showed a decline. Now, it could be an aberration, a blip, but some have suggested that this could be some of this nervousness creeping, trade-related nervousness creeping into the manufacturing sector already. That's the chart on the right side. And of course, the biggest risk is that tariffs could hit the consumer. If you look at the threatened 200 billion tariff on China that the White House threatened recently, that's going to hit the consumer pretty hard. If you look on the left chart, it shows how much consumers are buying from China, from cell phones, computers, clothing, toys, furniture, vehicles, appliances. All of that could suddenly become more expensive. What's more is, and we'll talk about that shortly, but that will boost inflation, which will force the Fed potentially to raise rates even higher, and further slowing the economy. On the right is a chart from Bianco Research that shows what people are searching for on Google. What are they concerned about, right? And the green curve is trade policy, and that's become a concern for the consumer, right? They're thinking about it for sure, and that's what this is showing. And of course, investors are obviously very uneasy about trade issues. It's the number one concern in this latest survey from Spider America's research, and you see geopolitical risks as trade tensions in particular becoming the number one concern. On the right is BlackRock's geopolitical risk indicator based on news flow, and you see the U.S.-China relations risk spiking as it did in 2012. Okay, so we talked about trade as one risk, so let's take a look at the second risk, which is monetary policy. So the Fed already has been pretty aggressive in its rate hikes since sort of 2016. Basically, this chart shows that if the rate hikes were any faster, it could this is measured by this thing called the reversal rate. It could tighten financial conditions so much that the economy could start to slow. And the Fed has been running right at that level where you could easily trigger if it's any faster, you could easily trigger a slowdown, and that could happen, right? So if you look at, we did a survey of the Daily Shot readers recently, and we said, and this was last week. We said, how many rate hikes do you expect this year? And 60% of them said 2. So 2 more rate hikes this year, in addition to the 2 we already had. That's 4 rate hikes in 1 year. And people say, well, so what? It's 4 rate hikes is 1%. So what's the big deal? it is a big deal because the U.S. has gotten used to kind of low rates for quite a long time, and a sudden shock like that could have negative consequences. You already see it in things like credit card rates. So credit card rates, for example, are near the highest levels in years, potentially decades. And that could have an impact. Just imagine you add more to this, more fire to this, and rates, automotive rates, and credit card rates, and other types of financing rates will go up, and it could become a problem. And all of a sudden you lose the economy, the participants in the economy lose confidence, and that's all it takes. So it's not necessarily the absolute level of rates as it is the speed at which the rate changes, and how nervous both the households and companies become in response to this. So far, it's been okay, right? But that could change. So here's a forecast from Capital Economics showing interest rates, Fed funds rates, going forward. So everybody's roughly the same for the end of 2018. And then if you look at 2019, the Fed itself is pretty optimistic that we'll get rates by the end of 2019. We'll get the Fed funds rate to 3%. But some other economists are not as optimistic about this rate increase. But look what happens at the end of 2020. So the Fed thinks, they'll keep on raising rates and all is going to be well. Other economists are not as sure that they'll be able to hike rates at the same pace. And Capital Economics says, you know what? They're going to have to start cutting rates. This is basically 2 years from now. They're going to be cutting rates because the economy will be in the recession, and because they've potentially overshot. They hike rates too much, and that's so that's a concern. So one of the signals that everybody is tracking these days is the yield curve. The yield curve has been flattening, and a flatter yield curve says that the market doesn't think that growth and inflation will be significant going forward, right? Especially relative to now. And so the curve hasn't inverted yet, because when it inverts, it typically forecasts a recession coming up. For now, what happens is the Fed keeps hiking on the short end, but the Treasury yields at the long end are not rising, and the 10-year yield remains below 3%. And so that differential says that there's confidence that the Fed will continue hiking in the short end, but there's less and less confidence in the longer trend in the economy. And so this flattening of the curve, and this chart shows the spread between the 10-year and the 2-year Treasuries, which is now below 35 basis points, is really could be construed, and not everybody agrees, but could be construed as a signal that a slowdown is ahead. So now let's go on to the third reason or risk for the end of the cycle, which is a stronger dollar. And in the United States, because we're a little more insular as an economy, people don't think of the dollar as a significant driver of economic growth, but it is, and people often forget that. In other countries, people are keenly aware of the value of their currency as an indicator of economic health, and that's why many countries have traditionally wanted to devalue their currency, because they're worried about the stronger currency will slow the economy. And so particularly export-focused economies from China, Japan, Europe are very uneasy about strong currencies. Australia, for example, is very worried about that, and the central bank spends a lot of time thinking about it. Not so much in the United States, but I think people often underestimate that risk. So this chart shows the trade-weighted U.S. dollar index, which is basically taking all our trading activity, the United States trading activity, and looking at the exchange rates with all those other countries, and sort of combining into a single index based on how much trade activity takes place with those countries. And that's on the rise. Obviously we're still below the 2017 peak, but it's climbing pretty quickly. And people say, well, why is it climbing? Well, it's climbing because of the stuff we discussed earlier, which is the Fed is being aggressive, raising rates, whereas around the world, the situation is quite different. Central banks in Europe or in China and other places like Australia or Canada, much more reluctant in raising rates, and so higher rate differential between the U.S. and its trading partners attracts investment into the U.S. So if you want to, you can keep your money in euros at negative interest rates in a bank, or you can bring your money into the U.S. and put them into 2-year treasuries at 2%, or even 1-year treasury at 2%, and that's a significant differential versus other parts of the world. In fact, you look at China right now. China is starting to ease. Their central bank is easing policy as the U.S. is tightening. And you have sort of a very dovish central bank in Europe. In Canada, the central bank has been pretty careful. I mean, they've raised rates, but they've been pretty careful. And so those differentials in policy and rates are causing the dollar to rise. And what the dollar is doing, higher dollar, is boosting, is basically tightening financial conditions. And what does that mean? Financial conditions is a general term to indicate how accommodative the various inputs into the financial markets are. From the dollar to interest rates to spreads and equity markets. How accommodative are those indicators for the economy? And this is saying that the dollar is making the situation less accommodative for the United States. This is from Goldman Sachs. So again, people say, "Oh, strong dollar is good." What's wrong with a strong dollar? Well, a couple of things. One is when the dollar strengthens, the relative cost of American labor, for example, rises, right? So you can hire 100 people in the U.S. or you can hire 100 people in Canada to do the same job. If the dollar is stronger, that 100 people in the U.S. are more expensive. And so you would, as a business person, you would say, hey, I'm going to hire 100 people in Canada instead. right? So it shifts the like offshoring, things like that become common when the dollar is stronger. That hurts the economic growth. It also, because a strong dollar means cheaper imports, right? Because a strong dollar buys more foreign goods, and those foreign goods come in cheap, which makes it harder for domestic businesses to compete with those cheap goods. And of course, the most obvious one is if you're an exporter, your exports immediately become more expensive abroad, making it harder for you to compete with products from other countries, right? So it hurts exports. If you look at the chart on the left, it shows the inverted trade-weighted dollar versus import prices. So as the dollar rises, import prices drop. And then on the right it shows your exports. If the dollar rises, U.S. exports drop. And so across the board, this is a higher dollar, stronger dollar is bad for the economy. In particular, it's bad for manufacturers because a lot of U.S. manufacturers export, and labor is a big issue. So when labor becomes expensive, and exports become less competitive because they're more expensive in dollar, when they're in dollars, manufacturers tend to shift to other locations because a lot of manufacturers have a choice, right? They always are looking at their portfolio of where they produce and say, how do I optimize that? And a stronger dollar will optimize it to push them to do more stuff abroad, right? So U.S. manufacturing could struggle. You'll say, well, that sounds kind of theoretical, but we actually had that situation. I mean, if you look at this dollar chart, in 2016 it climbed dramatically, right? 2015 to 2016, and this chart shows what happened to the U.S. industrial production. It went into a recession, so we had an ugly manufacturing recession. Even though it wasn't officially a recession for the whole economy, it certainly was a manufacturing recession. As industrial production went negative. And a lot of this is due to this rally in the dollar, right? It's that simple. A stronger dollar will hurt manufacturing. It also, one of the other reason was for the slower industrial production was that oil prices collapsed, and the U.S. has a pretty sizable oil producing industry and related industries to oil, and the collapse in oil prices also drove this down. But people debate why oil prices came down, but one of the triggers was a stronger dollar. So that's the impact. So a strong dollar is a much bigger risk in my mind than people often give it credit. So globally, if you look, the dollar doesn't just, a strong dollar doesn't just hurt the U.S. economy. It really has a negative impact globally. So this chart compares what they call detrended global GDP and the U.S. dollar on basically as how overvalued, undervalued the U.S. dollar is, right? Is it you can simplify it by using kind of the burger index, right? If you buy a burger in Switzerland, you buy a burger in Montreal or in New York, what's the relative cost? And a more recent example is using Starbucks latte. If you buy one of those in Tokyo or Moscow, what does it cost you? And based on these kinds of measures, a strong dollar tends to coincide with really depressed economic growth around the world. So it's not just the U.S., right? And it's a little bit of a feedback loop, right? It slows the U.S., slows the world, which slows the U.S., and it becomes a problem altogether. So that's that. So this is the dollar risk, and I think it's real. And if you people say, well, how much will the dollar continue rising, right? And if you look at last week, there was a record increase in hedge fund bets that the dollar will continue to rise. So hedge funds and other sort of speculative investors are convinced that there's more upside to the dollar. And the dollar is certainly, for one of the key indicators, the dollar is certainly rising against the renminbi, the yuan, the Chinese currency, and that we saw that that is already is risen for 5 days straight against the Chinese currency, which could be a signal that Beijing is sending to the White House. Is like, look, we don't have to fight you with tariffs. We can just weaken our currency to strengthen the dollar, and you'll feel the pain that way. So that's really an issue. Anyway, so let's conclude now, and we talked about some scary things and things that could go wrong, but there's no need to panic. For now, all this great fiscal stimulus, low taxes, all this government spending, government contractors are ecstatic. There's so much money flowing their way. And all of that is keeps the economy humming. And, tight labor markets keep people employed. And so when you have exceptionally strong labor markets, the economy will remain strong for now. You'll say, well, what's the risk of another 2008? And those are pretty low. And that's because the banking system, the general financial system is in far better shape than it was in 2007. And the banks are much better capitalized. I just saw the latest stress test the Fed did, and the banking system is really in good shape. So there's no risk of having to, obviously a recession means a slowdown in lending, but nothing crazy where banks could be in trouble. Profitability in the corporate sector is really good. Companies are highly profitable, and that's expected to continue for some time. And that means more hiring, and economy will continue to hum for now. And then, the U.S. is not as dependent on global growth as other countries. If you look at Japan, Japan's stock market, and you say, well, the stock market, based on whatever measures you use, Japan's stock market is highly undervalued, right? Because if you just if you just look at Japan's price-to-earnings ratio and say, why are they so cheap? Japanese companies are highly profitable now, and the reason is that the investors view Japanese companies and the Japanese economy as highly dependent on global growth. If the global growth slows, so will Japanese profits and the economy. And so it's a very different kind of economy from the United States in that sense. So, the U.S. corporate sector is dependent on global growth, but not nearly as much. And so is the United States economy as a whole. And finally, the next downturn is expected to be fairly shallow, nothing like we've seen in 2008. So, it'll be a relatively mild recession when it does take place. All right, with that, we're going to finish up. Thanks very much. By the way, for those who are interested in the Daily Shot, it's available on the Daily Shot, WSJ.com, all one word, DailyShotWSJ.com, and you can subscribe. And for those who are Wall Street Journal subscribers, can subscribe to it down here below. So with that, thanks very much, and John, over to you.
Sure. Thanks again, Lev. A tremendous amount of good information. presented. So thanks again. Early on in the presentation, you spoke about 3.4% GDP growth. Atlanta Fed predicting potentially 4.5% growth, and you said that a lot of this is because of tax cuts and government spending. Are tax revenues up?
Corporate tax revenue is definitely down. It remains to be seen what the personal income tax revenues are like. My guess is they will be up some just because wages are higher and more people are working.
Mm-hmm.
But corporate revenue is definitely down.
So where is the government spending increasing, and is that just adding to the country's debt?
It's adding to the country's debt rapidly, and the deficit is expected to escalate. And I think it's another presentation for another time. But that's a major concern, and people think that within the next few years, the debt will be the size of the GDP. Basically, it'll just continue to climb, where the spending is become ridiculously high.
Mm-hmm. All of this, a lot of this growth as well. Is it businesses that are increasing their CapEx spending? Are these individuals that are spending more? Where are you seeing the balance?
Yeah, Americans are definitely spending more. You saw improved retail sales last month. Not spending as much as the consumer confidence indices would suggest. If you look at consumer confidence, it's at decade highs, but spending isn't at decade highs, right? But it's definitely improved. So there's definitely better consumer spending, which is where most of the growth is coming from. Investment has improved. It's not dramatic, but it has improved. And so this quarter in particular, it will be consumer driven. That's what the economists are saying, that this quarter Americans went shopping big time.
Mm-hmm.
In part because the weather was really bad in the first quarter throughout the Northeast and other parts of the country, and so there was just less shopping. So they're out in force this quarter.
And where are businesses spending the tax cuts?
That's a great question. So number one, they're returning it to their investors. So they're doing stock buybacks. They're increasing dividends, and M&A, mergers and acquisitions, is on the rise. So they're using the extra cash to buy their competitors that emerge. So those are the three things. Now, investment is definitely improved, but that investment often doesn't show up in kind of the broader economy, because a lot of investment increases are done by tech companies. And what does Google spend when it does investment? What does it spend its money on? If it was GE would spend it on some production or manufacturing or something like that. But Google will spend it on things like data centers.
Right.
And so they spend a lot of money on new servers and data centers, and that's helpful for the economy, but it's not as helpful as more traditional corporate investment.
In one of your previous webinars, presentations, you spoke a little bit about, I think you referred to it as the Amazon economy, and how does that all factor into this? Because it's different, right? It's an unknown to us.
Yeah. So clearly Amazon is a powerhouse, and it does help economic growth, because you look at the amount of hiring Amazon is doing, and it's pretty impressive. I mean, they're putting distribution logistics centers around the country and hiring more and more people. So they do have an impact on growth. And in fact, Amazon hired a lot of those people that were laid off by traditional retail centers. So it does have an impact on the economy, but it's not, like you said, it's not the same kind of growth, and their investment tends to be different, right? Again, it's thousands, server farms and improving their IT infrastructure and their retail distribution networks. Which again is helpful for growth, but it's not the same as, say, if GE was doing the same amount of capital expenditures, because it would just hire thousands of manufacturing workers and so on. That's not happening.
Gotcha. You also spoke about the freight index and how that's. And I guess is it a leading indicator or a trailing indicator?
I think it's a leading indicator or coincident indicator, but freight is, companies are complaining that they're having trouble with deliveries because the demand is so high. And you look at things like long-distance trucking. Long-distance trucking is a problem because nobody wants to work those jobs, right? And there's just not enough drivers. And so you're getting into delay issues and other things like that. But the demand continues to climb. People want more stuff shipped, from construction materials to oil drilling equipment to packages that come to our home. We need, trucking. We need that system working, and that's the demand on the system has been great. But if you look at, it's harder to, almost impossible now to find long-distance drivers who are qualified and want to work. And, the U.S. highway system isn't exactly up to par, so there are delays around that, and that's causing some bottlenecks and causing prices to rise, which is what a lot of companies are complaining about.
I think I read in the journal that trucking was running at 110+% of capacity right now.
Yep.
I might be off with that, and that the cost of moving a truckload of product has more than doubled in the last 18 months. Is that about accurate?
That sounds right.
Wow.
Yeah.
So that actually will impact inflation.
It does, and it already has. And if you look at regional Fed surveys, manufacturing surveys and non-manufacturing surveys, they will all say, our input costs are going up. And people say, what are the input costs? Well, clearly aluminum, steel are two items. Housing, things like cement or concrete and lumber, which is also driven by tariffs the U.S. imposed, those are high. So those are the materials where you see increases. But then also fuel, gasoline prices have risen dramatically. So fuel prices have risen, and shipping costs have risen. Those things that I've just mentioned basically make the bulk of the price increases that companies around the country are seeing. Right. And that's what they're complaining about. And you see that in the Fed's beige book. You see it in the regional survey reports. And some of them are passing higher costs to the consumer, right? Which has, the inflation has been ticking up. The issue is, is this sort of sustainable? Can they continue raising prices given that wages are not growing as quickly? And so at some point, margins have to give. And that, I think we're going to see some of that, tighter margins because of higher costs. You saw that one of the I can't remember, it was one of the largest U.S. manufacturers who basically complains that our margins are tightening, and the stock dropped pretty quickly. Right. Procter & Gamble, I think it was, yeah.
So our three risks: trade, monetary policy, stronger dollar. What are the growth impacts of these to the stock market?
Yeah, so trade risk is, obviously, and we've seen this in the stock market, hits industrials and tech, such as semiconductors, but in industrials, people who export abroad, Caterpillar, Deere, those kinds of companies, Boeing, those are the companies that got slammed because, GE, General Motors, Ford, those are the companies that got slammed because of the trade risks, and that's where you see that impact. The other risk is the monetary policy, the Fed, and that impacts sectors such as home builders, right? So higher rates impact home builders, real estate firms, but also they hit the consumer sector. As we've seen, credit card rates jumping, that's impacting the consumer sector. So that's if the Fed raises rates too aggressively, we'll see that impact. Banks typically benefit from higher rates, but obviously if the consumer pulls back, banks will get hurt as well. The third one is the dollar, and the dollar tends to hit large cap companies, multinationals, because if you have profits in euros, abroad, when you translate those into dollars, when the dollar is stronger, those profits will look smaller in dollar terms, and that's one of the reasons. And obviously, exporters, manufacturers, raising offshoring risks and things like that.
Continuing on this, related to the strong dollar, how do you think that the stronger dollar will affect the European market debt, and is there any concern about countries with huge dollar-denominated debt levels?
Yeah, so stronger dollar is good for Europe, right? Europe loves a stronger dollar because it makes it easier for them to export to the U.S. European products become cheaper in the U.S., and so they want that to happen. Tariffs aside, right? And tariffs obviously destabilize that whole situation, but Europeans love that. But countries that have borrowed in dollars, such as Turkey, will struggle. Or you look at Argentina, right? Argentina, the government borrowed a lot in dollars. Turkey is companies that borrowed in dollars. Argentina's government borrowed in dollars a lot. And so when the dollar strengthens, their liabilities in their domestic currency climb pretty quickly, right? And so you owed $100, now you owe $120 very quickly without anything happening, and so now how are you going to repay that, right? You didn't count on that. So the strong dollars is going to really take a hit. Some of these countries will take a hit when they borrowed in dollars. And why did they borrow in dollars? Because rates were a lot lower, and so they said, "Oh, it's fine, no problem, we'll just borrow," and now they're paying for it.
And where is the balance with the dollar? Where should it be, where it isn't too strong but it's not too weak?
People debate this. Some people say that it's probably good where it is now. And if it stays at the current level, I don't think there's much of an issue. The concern is that we're going to get another 10% appreciation,
wow.
Which is quite possible, right? And that's when it becomes overvalued. But for now, people are saying it's roughly where it should be, maybe a little too strong.
And last question before we wrap. Besides the three risks that you've identified, any others?
Yeah, so I think things like geopolitical risks are still out there. Say conflict with Iran could destabilize global growth, and it could become a real issue. South Korea, as much as people are saying, "Oh, that's all sorted out," it's not. It could again flare up, and it could be other similar issues from Turkey to Pakistan. Mm-hmm. So these kind of geopolitical issues could come up that unexpectedly, and could even be a string of terrorist attacks in the United States that people are not counting on. Those kinds of things could easily destabilize the economy. That's the first one. The second one, I think the the United States is so polarized right now politically. Certainly most of us have never seen anything like it. And that hostility could spill over into, some unexpected, unintended consequences where government makes decisions that are that could derail growth. I can't tell you what those are, but I think there's a lot of tension in this country that could spill over.
Sure. All right. Well, thanks a lot again, Lev.
Thanks, John.
We've gone over, but but it looks like everybody stayed with us for the full hour plus, which means that they appreciate the content. We appreciate it, and we always look forward to these sessions.
Thanks, John.
So for anyone, thanks a lot for joining us. And if anyone has any further questions, please feel free to email them to us at webinars@starmountaincapital.com. We will be sending everybody a copy of the presentation tomorrow in email. We'll also be putting up a replay to this presentation on the Star Mountain Capital SoundCloud podcast page and on our YouTube page. Thanks a lot, everyone. Thanks, Lev. Thanks for joining us, and we will see you next time. Bye-bye.
Bye-bye.